A very good afternoon, sir, and all our esteemed participants attending this 19th webinar of the ICSI Master Knowledge Series Triple E. I am CS Richa, and it is my privilege and honor to host this webinar on behalf of ICSI. I, on behalf of the Institute, extend a very warm welcome to all of you. Friends, this Master Knowledge webinar series is an initiative of ICSI to disseminate and share expert knowledge on various topics of professional interest covered under the Companies Act, SEBI regulations, and other corporate laws. It is with your active participation and support that we have successfully organized 18th webinars so far and now entered into the 19th webinar of this ongoing series. Friends, the topic for today's webinar is Corporate Restructuring Building Strategic Alliances. In today's session, we will explore the intricacies of corporate restructuring with a particular focus on building strategic alliances. Corporate restructuring is a dynamic process that involves significant changes to a company's structure, operations, or financial structure. Strategic alliances, on the other hand, play a crucial role in achieving long-term success by forging partnerships that leverage the strength of each party involved. To deliberate more on this topic, we have with us our eminent speaker for today's webinar, CS Nitin Somani, who will guide us through the nuances of corporate restructuring, shedding light on strategic considerations and practical aspects of forming alliances that can drive organizational growth and resilience. CS Nitin Somani is the founder director of Sunday Capital. He is an astute professional with over 2 decades of experience in the financial industry in India. His rich experience spans across various segments of financial industry, including merchant banking, fundraising, capital markets, corporate and financial structuring, mergers and restructuring, business valuation, stock incentive plans, distribution of financial products, and also have in-depth knowledge of finance and compliances. His expertise includes working on technical assignments with unique solutions to achieve optimal structure and value creation. Mr. Somani is a fellow member of the Institute of Company Secretaries of India, registered valuer for securities and financial assets with IBBI and CFA from ICFAI. He has also been conferred an honorary directorate by École Supérieure Robert de Sorbonne, France, in the field of demerger and value unlocking. He has been a regular speaker at various programs of ICSI and has also been associated with various programs at regulatory forums, ICI, PhD Chambers of Commerce and Industry, DD Gyandarshan, etc. We welcome you, sir, and we are fortunate to have you as an expert speaker for this webinar. Over to you, sir.
Thank you. Thanks a lot for the introduction and making it compatible with your viewers over there. Good afternoon, everyone. I'm Nitin Somani, and by profession, I'm a company secretary, but practicing into the field of advisories. Today, the topic which has been entrusted by the Institute to me is talking about the merger, demergers, and restructuring exercise. Along with it, how we can get associated with various parties who are involved into such kind of structure. So we will walk through the transaction, how the merger, demergers, and the synergies and the kind of benefits are created. Along with each and every aspect, we will also, in short, somewhere cover that how these strategic partnerships or the result-oriented solution can be given to the client. So I'll start sharing my presentation on this. So first of all, we should understand that why a corporate restructuring is required. Because whenever companies start the business, they continue the business, they expand their businesses, but why is actually they want to go for merger, demergers, or any kind of a spin-off or slump sale or any kind of a strategic alliances? So whenever a business starts, the company is not very sure of the success of that business in future. There are various kind of uncertainties covered in each of the business. Certain times high capital infusion is also required. So when the company commences the business, the capital is pulled into the company and the business starts. Over the period, the business gradually grows and then the cash are generated. So these surplus cash generated either have to plow back will have to be withdrawn by the promoter as part of dividend or buyback, or otherwise the company can use the cash and invest into new business opportunities. So what happened? There is a company which started with a particular business activity, but over the period it expanded and diversified into different business activities. These expansion can be directly by the company or can be through a subsidiary below the company also. So this is how the businesses expand. Once the business expands, then there has to be a point wherein fresh capital is required for the new business also. Because the business idea which was nurtured by the main company, as soon as it matures, you need growth capital. So here comes the process of unlocking the value of each of such company. So when we do this unlocking of value, we primarily look forward for few kind of restructurings which can happen. It can be financial, it can be technological, it can be market related restructuring, or it can be organization. Financial, we always talk about the numbers, that how the value can be created and value can be expanded for each of the investor into the company. Technological is something you are carrying on a traditional business, but you want to migrate to an electronic platform or a new technology to be implemented into the company. Again, you require some sort of restructuring. Market restructuring, you predominantly operate into a region, say Western India, but you want to expand into new markets. So these kind of strategies are called as market restructuring. And organizational, somewhere you do the regular shifting. So if I share an example, there are various large conglomerates in India who have different business verticals. So if a person grows into a particular business vertical, to give him better opportunities, they move these employees, these key personnel from one organization to other organization. These are called organization restructurings. These are the details only which we have already discussed. Then these restructuring can also be done based on different modes of restructuring. It can be merger, demerger, acquisition of a business or a company. It can be a reverse merger. It can be a disinvestment or slump sale, or through a joint venture and a strategic alliance. So joint venture and a strategic alliance, these are two separate things. Rest all can be covered into one common bucket. So first we talk about merger, demerger. So where in merger and demerger, two different businesses operating in two different companies, they get merged into one company. And this is generally done by exchange of securities. Similarly, in a demerger, the entire business is into one company. You break it and move it to another company. That is demerger. Again, this is done generally by allotment of securities. Why allotment of securities is being done? The answer lies under the Income Tax Act. So if you do a allotment of security and you maintain minimum 75% of the common shareholding in terms of allotment to the new shareholders, then in that case you are eligible for tax neutral structure for merger or demerger. That means there will be no capital gain taxes on transfer of the business assets. If you do not qualify with the condition and you, for example, you make the payment in cash on account of merger or demerger, then the transaction will become taxable. So that is the reason why it is always done through allotment of securities. Then there can be acquisition. Acquisition means that you can go ahead and acquire directly your competitor company or another new company. This acquisition will lead to change in control and ownership both. Then reverse merger, as the name says, that you are doing a merger but into a reverse manner. That means a healthy company is merging into a loss-making company, or a large company is merging into a small company. These are generally done to avail benefit to the small or the loss-making company. Then comes the disinvestment and slump sale. So the disinvestment and slump sale can be either of a particular identified asset, or it can be either also for the entire undertaking. When we say entire undertaking, so no individual values are assigned to any of the asset or liability. It is a lump sum consideration which is paid. Then the next two are joint venture and strategic alliance. Under joint venture, two different entities with a common objective come and form a new entity. So these are called joint venture. There are two or more joint venture partners. Each partner has a responsibility to bring their strength into the joint venture. And that strength is pulled into a new company to develop or create a new line of business. However, strategic alliance is more in form of an agreement where two people or two entities agree to a common understanding and then they continue with their business. So This is more in detail when we discussed about the merger and demerger, the tax neutrality of such kind of transaction. So these are predominantly the definition under the Act, which the Institute can share the presentation and you can go through it. So these are regulatory definition, which talks about that what has to be the essence of the merger or demerger exercise so that it qualifies for tax exemption. Now, reverse merger, as we discussed, the major reason for reverse merger are either first, you can carry forward the losses of the smaller or loss-making company so that the profit-making company can adjust the carry forward losses and can continue and then earn the benefits. However, again, you have to comply with certain provisions of income tax so that you are able to carry forward the provisions. Second is the economies of scale of production, which can be created. Third could be a marketing network, which a small company may have in a local area, but a larger company want to penetrate into that small area. So they can look for such kind of integration. And then to protect the trademark license agreements or different other assets of a loss-making or small company. Then under reverse merger, if we are talking about a listed company, the listed company will be predominantly the profit-making company, the loss-making company will be unlisted company, or the small company will be unlisted. Then there has to be a merger. So in such cases, the unlisted company has to get listed. So there are certain requirements of SEBI regulation which have to be complied with because a listing cannot happen without an IPO. So the company had to go for exemption under Rule 19.7 of Security Contract Regulation Rules. These details and the processes are more elaborated in the SEBI's Master Circular, which was issued in 2023, and this is routinely updated by SEBI from time to time. Then what if the conditions pertaining to definition of amalgamation or demerger, which are provided under Income Tax Act, are not complied with completely? So in such case, these are not tax neutral structure and the assets of the transferor or the transferee company will attract capital gains. So the capital, and secondly, the carry forward of losses will also be not allowed. So you have to create a structure which is tax neutral. Now in doing so, if you have an internal expertise to create the tax structure and the eligibility for income tax exemptions, you can do that internally. Otherwise, you can get associated with such kind of tax advisory firms who provide similar advices. So you can go ahead with creation of a scheme, the structure. However, the taxability and the neutrality of those structures will be vouched and verified by a taxation expert. Then slump sale. Slump sale is basically where business is sold off as a going concern, the entire business undertaking, and there is no separate consideration assigned to each of the asset or liability. Slump sale is generally for lump sum consideration, and the materials available on record do not indicate item-wise value of the asset transferred. This is taxation falls under Section 50B of the Income Tax Act, which is predominantly the net worth of the undertaking is treated at the book value. Any consideration paid over and above that will be liable to capital gain taxation. Then there are some more kind of schemes which can come out. These schemes can be pertaining to consolidation of face value of shares. These can be for reduction of capital in case of loss-making companies or the surplus cash is available, so cash can be repaid and capital can be reduced. Then there can be a scheme of arrangement or compromise between the shareholders. And the last is to issue consideration in non-equity instrument forms rather than cash consideration or equity consideration. The third point, which is the schemes of arrangement or compromise. Generally, in such a scheme, there are no merger demergers involved, but a particular asset or liability is being transferred generally to another party. So these are called as the schemes of arrangement or compromise, which is between two shareholders of two companies or the creditors. Now, merger can be for few objectives. One is a horizontal merger. As the name suggests, there are two firms on the same level and they merge to create a larger company. Few examples are also given over here. Second is a vertical merger. Under vertical merger, it is more about integration of the business, which may be forward or backward integration. Then there can be a market extension merger. That means you want to extend into a new market, so you acquire a primary player into that new market, so that you get a ready-made network available for your business. Then there can be product extension merger, wherein you add a new product to your business line by making an acquisition. And then there can be conglomerate merger where there is no specific objective, but you create a much larger firm and you use the common features or the synergies are created in terms of operations of the businesses. Now, what are the objectives of doing a corporate restructuring? First, the deployment of surplus cash to finance future opportunities, which we discussed. Second can be development of core competencies. A company, they may be doing good into a business, but they want to penetrate a new business. So they will acquire a company which is already operating into that new business segment. This acquisition will help them to create better competencies and structures in terms of their business operations and the quality of product which they offer. Then orderly redirection of firm's activity. There can be risk reduction also by acquisitions and merger demerger exercise, because it might be possible you are running two different businesses which are basically controlled by two different regulators into the same entity. When you demerge these businesses, you reduce the regulatory risk of one business falling onto other business. So that leads to risk reduction also. And then exploiting interdependence among present and prospective business opportunities. So whether there would be dependence on two businesses which are already run or not, forward and backward integration will be there or not, all these kind of reasons can be there. Then what are the rationales? Broadly, again, similar kind of rationales have been elaborated. First is to increase the operating efficiency by pooling of resources or economics of scale. Second is to maximize the value of assets. Third, to improve access to financial markets or listing objective. It can also work as a panacea for corporate turbulence in troubled times. It can be to reduce the risk, to obtain tax benefits in case of reverse mergers. It can be expansion of marketing and management capabilities. The nature and the style of working of the top management also matters. Then it can provide synergy benefits, or yes, family settlement is one new thing which has come up in last few years. So even the scheme of merger demergers are certain times undertaken for family settlements. So you bifurcate the businesses into two different companies, and the companies are then handed over to the residual partners who will continue these businesses in future. Enhancement of shareholders' value is always an objective of any kind of restructuring. Now, what are the synergies which you achieve by doing this merger or demerger? The synergies are simply two, if I would brief. One is financial synergy, second is operational synergy. Financial synergy is basically in terms of anything which you can monetize and calculate in monetary terms. Operational synergy is the benefits which you can achieve without actually arriving at the value or the benefit of the value which has been arrived. So these are two different synergies. Ultimately, what is the objective? 1 plus 1 should be more than 2. Or if you are doing a demerger, then 2 minus 1 should be more than 1 plus 1. So that there is a value enhancement happening for the shareholder. Now, what challenges you see while doing such kind of exercise? Achieving commercial rationale and synergies. That is one challenge, how to arrive at such kind of synergies and the benefits. Second major impact is the transaction costs, which may be in form of taxation under income tax or maybe stamp duty. So these two are the material costs. You have to be very mindful when you are doing a transaction and there is a real estate involved. Then you have to definitely check the local stamp act for the applicability of the stamp duty. And then regulatory approvals which are required, approval of a stakeholder, that is shareholders, creditors, parties whose interests are affected. Then valuation of entities will be required and the time frame. Now, when we talk about all these 6 points, everywhere you can try and create synergies with your business partners. When we talk about the achieving commercial rationale, so we are talking about all kind of taxation aspects, the transfer costings and other aspects, the transaction cost. You would be requiring a partner who is very well averse with the taxation laws in India. When we talk about regulatory approvals or approvals of a stakeholder, there may be a requirement of a partner who regularly works with such kind of companies or industry. For example, if you are doing a merger which is attracting competition commission approval, and you may not be dealing with competition commission on day-to-day basis, or there is an NBFC which is getting merged, you require RBI NOCs. So under such cases, you can always look for a partner who can help you in getting these kind of structures prepared from these parent regulatory requirements also. Valuation of entities, this is one area which is always open now for company secretaries also. However, under valuation of entities, you have to maintain one status, that if you are undertaking the transaction structuring, you should not undertake the valuation because that leads to conflict of interest. So you can do either one of the activities. So based on your business and the commercial interest also and the relationship with the client, you can take a call on to which role you want to play. And the time frame is something which has to be decided. Generally, in case of unlisted companies, the merger timeframes are lower, especially if no sectoral regulator approval is required. If sectoral regulator approval is required or the company is a listed entity, then the time frame can increase. So what is the regulatory framework or what kind of laws will get attracted? Predominantly the Companies Act, which a company secretary can absolutely handle. Then comes the Income Tax Act, for which you may have to rely on a fellow professional for certain aspects. Then the stamp duty, again, it can be taken in-house care of. Accounting treatment is something for which the auditors will always come into picture. SEBI is one area wherein there may be one or two, three requirements wherein a merchant banker is required. Otherwise, again, in terms of application preparation for getting in principle approval from a stock exchange, final listing application, they can always be prepared in-house. Then FEMA, in the FEMA regulations, you may require assistance of a RBI expert. Competition Commission is again a specific law wherein very few people are participating. So again, you have to build up relationships over there. Indirect tax, again, can be taken care of in-house or you can partner in with the associate also. This is the process which broadly, I believe everyone knows that how the process of demerger works. We'll just move to the next slide. Now, this is something which is there as an additional requirement for listed companies. When we talk about a merger or demerger of listed companies, these are also governed by SEBI. SEBI, through their master circular, has from time to time specified various requirements. Certain of the aspects are also specified by stock exchange by way of SOP circulars. So for a listed company, you need to obtain a share swap ratio report and a fairness opinion. These have to be approved by the board before approving the scheme. Then the approval of the audit committee and committee of independent directors is also required in case of listed companies. So before the board meeting happens, probably either on the same day or day prior, the audit committee and the independent directors, they will meet separately into different meetings, and then they also give their opinion. The audit committee have to give the fairness and assessment of the scheme and the share swap ratio. The independent director committee is predominantly given the authority to comment on the scheme whether it is fair and not prejudicial to the interest of the shareholder. This is something what independent director committee recommends. Then you have to obtain a lender NOC. It is a prior requirement. In case of unlisted company, you can just obtain the consent later at the time of seeking either exemption from NCLT for convening the meeting, or you need a NOC otherwise. However, in case of listed company, it is a prior requirement before SEBI observation. Then the observation from SEBI and stock exchanges comes, after which you can file the scheme with NCLT. There is one more requirement under SEBI. Under normal scheme, when you take an approval, the shareholders have to approve it with 3/4 majority. However, in SEBI, if we are talking about a listed company and one of the company which is getting merged involve promoters, or the promoters holding it getting impacted for that merger, the company will have to seek two kind of approvals. One, a normal approval with 3/4 majority. Another, which we generally say as approval of majority of minority. That means ordinary approval of the public shareholders should also be obtained. If you get both these approvals, then only you can go ahead and implement the scheme. Otherwise, the scheme will stand withdrawn. Then post NCLT approval, you have to file the scheme with the stock exchange and SEBI and get the listing approvals. Further, for the valuation professional, there is one more requirement which has been specified by the stock exchanges. This requirement is that whenever you give a share swap ratio, you have to give the table in your report. The table basically says that whether you have adopted all three approaches of valuation or not, and what is the weightage given to each of these approaches. If you are not adopting any approach of valuation, then you have to justify the reason for not adopting such approach of valuation. Once you give all these reasons, you have to incorporate the table in your valuation report, and then only you can close the valuation. Few matters of emphasis with respect to mergers. You have to be very mindful about the valuation and the basis of valuation. GAR implication will also have to be seen. Whether you require additional authorized share capital or not, the delegation of powers during the pendency of the scheme, and especially you have to see how the dividends are being managed during this period, because dividends certain times become very tricky. Then there would be applicability of Rule 11 UA to allotments under the scheme, whether it is there or not. This also have to be advised to the client. Then differential voting right shares, if anything, is proposed to be issued or is already existing in the company. Then for the income tax purpose, transfer of business undertaking is tax neutral if you qualify with the definition of merger or demerger. It will not attract capital gain tax. If you do not qualify, then there will be capital gain tax liabilities. Then taxation or allotment under section 56(2)(10) also need to be verified. Generally, these are done at fair values, which are approved by NCLT, so no taxation falls onto it. But you have to be clear in terms of what taxation implication can be there. Then carry forward of losses in case of merger. Thereafter, corporate loss. So a scheme before the tribunal must not violate, override, or circumscribe the securities law and stock exchange requirements for a listed company. Unlisted company can be listed pursuant to the scheme without an IPO if you go with 19(2)(b) and 19(7) relaxation. Stamp duty. So most of the states, as of now, they have adopted order of the NCLT or the order of the High Court, previously High Court, as a conveyance deed under the Indian Stamp Act. So you have to verify that whether the state in which the registered office of the company is situated, what is the definition of the word conveyance, and whether it includes a High Court order or not. If yes, then such High Court order is also attributable to stamp duty. There have been few various judgments also in this regard, predominantly a Delhi High Court judgment which deals with the stamp duty on such mergers. Then if you have registered office of transferor and transferee company in two different states, then the stamp duty may be applicable in both the states also. So again, the provisions of a Stamp Act become very relevant. Earlier, there was a judgment which said that in the terms of merger between a company and a subsidiary where not 90% beneficial ownership is held by the company, such transactions were not subject to stamp duty. However, this order has been withdrawn later, and therefore such transactions are also applicable to stamp duty. This is again carry forward of the losses. Again, you have to comply with the requirements of the Income Tax Act for being eligible to carry forward these losses. Now, what aspects have to be considered by planning for restructuring? So first of all, you should understand the business structure of the company. What business the company undertakes, what are the synergies between the business, what are the complications involved into each of the business, how a business runs, even that is also relevant for that matter. So you cannot give advice to a client unless until you understand the functionality of that business and the operational nitty-gritties. So that's the first and foremost thing. Thereafter, you have to understand the valuation and the funding requirements, if any, how the valuation will work and how the funds will be made available in future. It might be possible today a company is running a high profitable and a low profitable business both. If you're demerging one of the business out of it, so you have to assess that how funds will be available for the low profitable business in future, whenever required. Then third aspect is broadly covering next 3 points, which is legal aspects and procedure, due diligence and taxation. And then there can be other synergies, cultural competition, which have to be studied before you plan for any kind of restructuring. When we talk about business, so predominantly you have to understand the present business operations of the company, the area, geographies in which they operate, the products which they offer, the regulators under which they require approval, the business licenses which they own, whether such kind of licenses are transferable or not, everything have to be studied. Then you also need to understand the proposed business plan in case of merger or demerger, any kind of a transaction. Then present management and team strength is also to be understood. For example, you are demerging a business into two. Now there may be KMPs who are just one for the transfer for the demerged company. But when we talk about the resulting company also, you have to create two parallel KMPs for both of the business segments. So you have to predefine all these targets beforehand so that you can achieve these compliances also, and you can create such kind of management teams also immediately upon demerger. Then what are the objectives to be achieved by way of the demerger or merger exercise? That also need to be jotted down upfront so that you are clear on your strategy and the path on which you have to go forward. Now, when we draft any kind of a scheme, there may be a requirement that some of the companies look forward for lawyer or LLB degree because the drafting of such kind of a schemes requires certain legal intricacies also. So you can look forward for lawyers also when you draft the scheme and create the objectives and to understand whether such kind of a scheme can be approved by the NCLT or not. The second question which comes is valuation. So what is valuation? Is it science or is it art? We have come across through this many times. So there is no definite answer to it. Mostly it is art, but yet the relevance of science will always prevail. So there are certain aspects related to valuation. Valuation, first is that being a more detailed aspect relating to any transaction require detailed discussion. Secondly, valuation is a subjective issue and is always influenced by individual perception of the business, financial future outlook, and risk associates. Why so? If you go to a stock market, any share will get traded on every day. For example, we talk about any Nifty 50 company. There will be buyers available every day. There will be sellers available every day. Does not matter the share prices move 5% up or 5% down. The market will always have buyers and sellers. Why? Because each of the entity, they believe that the market or the price of the share is going to move up or down in future. So their valuation perception of each company are different. This is what leads to a difference in valuation. As a valuer also, if there are two valuers doing a valuation for a single asset, they may or may not arrive at a common valuation. The next is industry benchmarks are available from certain non-independent sources certain time, but it's still driven by personal influence. So if you are going to say Damodaran and taking any industry source, you have to be mindful that that data has been derived and have been calculated by an individual or by a separate entity. So it may be influenced to that extent. So you always have to be careful while using such independent source data. Then generally appointed date is perceived to be the date of valuation. However, valuation should be on a date more closer to the board approval. So if some company is doing is undertaking a merger exercise today, you have to take a valuation report which is more recent. You cannot go ahead with the valuation of the appointed date, which may be 1st April 2023. Then the stock exchange have issued certain operational circulars, including for valuation, wherein they say that for valuation methods other than income approach, these should not be numbers older than 3 months. Then the board of directors, again in case of listed company, have to consider the proposal of restructuring within 7 days from the date of issuance of report. There are some more requirements for related to valuation, but those are applicable only to the listed company. Then no such time period is provided in the company as to which what date should be considered for valuation or share swap. However, as we discussed, more closer to the date of board approval, more relevant is the valuation. Now there are certain quotations which are available. So a market value is one agreed between a willing buyer and a willing seller. However, valuation is an individual perception. So it may be possible that I'm giving a value, in case of a slum sale, I'm giving a value of the undertaking at 100 rupees, but the party can always agree to buy or sell the undertaking at 105 rupees or 95 rupees also, because negotiation is over and above the valuation. Then what are the methods of valuation? It can be 3 approaches are predominantly used. One is the cost approach, second is the market approach, and third is the income approach. Under the cost approach, we can use the cost to build or the replacement cost. What would be the money required to create similar kind of business? Second is the market approach, in which you can do a comparable company valuation. or you can also vouch for certain transactions which have happened in the similar industry or for similar kind of businesses. So under market approach, you do a comparative valuation. Certain times the company itself is also listed on the stock exchange. So you can also take the share price of the listed company as a benchmark for market approach. Third is the income approach. Under income approach, predominantly it runs on future estimates of the business. The future projections have to be drawn out, and then the cash flows have to be calculated with appropriate rate of discounting. You arrive at the value. While doing the future estimates and the income approach valuation, you should always ensure that you view and see how the projections have been built up. These have proper assumptions available in terms of how the business, the revenue, and the expenses are growing or falling down. What are the reasons for increase in the profits, and what are the working capital requirements? For example, if there is a trading company currently operating at a profit margin of 4%, the profit margin can be 3 or 5 or 6 in future, but that profit margin cannot go to 10%. So these are certain judgments which have to be brought in by the valuer while undertaking the valuation. Now, as Professor Aswath Damodaran has said, to truly grasp valuation, you have to be able to understand and use all three approaches. You cannot go with single approach, and there is a time and a place for each approach, and knowing when to use each one is a key part of mastering valuation. So you should understand that which approach is applicable on which kind of company and at what point in time, whether the company is at growth stage or it is at the normal business level, or it had reached to a matured level, or the businesses are falling. So each kind of stage of a company requires different approaches to valuation. Now, there are certain misconceptions about valuation, which anytime when you sit with a valuer, you can always argue and you can always discuss on these points to come out to a more logical calculation. So the first is evaluation is an objective search for true value, but no, the valuations are always biased by the individual perception. It's only that who have how much kind of confidence onto the industry and what kind of perception toward the growth of the business of the company, which will determine the valuation. Second is a good valuation provides a precise estimate of value. No, there is no precise valuation as such. Even a company like Reliance, daily the share price will movement, so a value cannot be a precise estimate. The third is the more quantitative model you use, the better will be valuation. However, it is contrary. The more models you deploy, it might be possible that you do not get a logical solution. Rather than it just becomes a calculation exercise with different models instead of arriving at a valuation. Now, there are certain differences in terms of valuations for different professionals. So these are few summary questions which we have been able to brought out onto the table. One is that what is the unsystematic risk associated with any company? Unsystematic risk is basically the risk associated with that company. When we say systematic risk is something which is present across the value chain. So that is the industry risk. But unsystematic risk will also need to be verified. Then what debt equity ratio should be considered, whether it should be for the company or it should be for the entire industry we should take. Then if the unlisted company comparable with any listed company, then you have to see the similarity in the nature of business, the size of operation, the services provided or the product manufactured, the governance standard, the quality of management and whatnot. So these comparisons will actually lead to fairness in the valuation. For example, if there is a retail company, a listed company is having 10 stores, however, the listed company is having 100 stores. You cannot compare both the companies because both companies are operating at a different scale of operations. So you have to identify an ideal peer set which can be compared. If there is no ideal peer set, then you have to arrive at a basis of providing a discount to the valuation of the larger company so that that valuation metrics or that valuation parameter can be applied to the unlisted entity. Then is NAV a realistic value or simple liquidation value? You will always come across to a question that what should be fair value? Can it be less than NAV or can it be more than NAV? There are various listed companies which are traded today also at a value less than their NAV. Does that mean that the fair value present in the market, whatever is the market price, is fair, or NAV should be fair? So you have to be ready with the answer. You have to be ready with a logical justification for this. Then which approach has to be used? Again, it depends on the industry, business, this level of operations of the company. For listed company, while considering market approach, if pricing under regulation 164 is also required, and is it only sufficient, or you have to deploy different other methods? Whether independent valuers should rely on the judgment of the promoter company for their future projections, or they can take their independent call. How much weightage has to be given to the each method of valuation? Then whether when two valuers are appointed, should they give joint report or should they give separate reports? Again, this is one question which very frequently comes across. And then should DCF numbers be disclosed in public as it contains projections, especially for listed company, because this is UPSI. So when you are handling a transaction and you are doing the structuring for the client and valuation is being done by an associate partner or an independent valuer, so you have to ensure that all these points and all these similar kind of questions and few more which may be there based on the industry and the company, these are already addressed upfront, so that whenever question comes on valuation, you are able to provide an answer to it. As a professional, you can always cross-question these kind of assumptions also while undertaking such transactions. Then next aspect is with regard to the due diligence. There can be certain due diligence which you can take internally, be it corporate law or be it any other commercial law. But there can be certain due diligences wherein you have to rope in your business partners in terms of financial diligence, cultural diligence, and IT diligence. Legal is something which we all understand it is predominantly related to laws of the land and whether you are complying with or not. Financial due diligence is predominantly related to the business numbers. As a professional, we are able and capable of undertaking such kind of financial due diligence also, but you can always rely on your business partner for undertaking such valuation. Taxation due diligence, again, it comes with the kind of taxation expertise which you carry. The other two diligences, which we call cultural and the IT due diligence, I'll be focusing a little more onto it because with the opening up of the economy to a larger extent and the new business models, ideas, the manner of conduct of business coming up, these have gained more significance in the current times. Now, why is a due diligence required? You require due diligence to understand the business. Because if you do not know the business, you cannot understand what registrations are required by the company. So these things go parallelly hand in hand. Then for assessment of value of the company, you need to undertake due diligence because value is mostly impacted by financial numbers. Then drafting and negotiation. The drafting and negotiation can be either in case of JV agreements or strategic alliances, or drafting can always be there in case of schemes of arrangements also. You should be able to identify potential risk also and tell client upfront that these are the risks which need to be addressed upfront. Because today we are all the kind of businesses are operating. Risk is a very predominant phenomena, and risk has to be mitigated upfront. Then estimation of current and future liabilities, and thereafter an informed decision has to be made about the entire investment structure. So when we talk about cultural due diligence, so cultural due diligence do not require any expertise per se. If you understand the business and the processes and the way of conduct of the management, you can always undertake the due diligence. Otherwise, you can always partner in with someone who understands these kind of cultural values which are related to the business. These cultural values are predominantly taken care when we talk about large conglomerate mergers or larger companies which are going out for mergers. So a financial due diligence will assess the financial health of the company. However, a cultural due diligence aims at identifying the relevant culture differences. We will go through some examples also for this. A cultural due diligence will help to align the policy, culture, and conductive work atmosphere for all the employees, both merger or demerger. Then for whom cultural due diligence? for companies who want to improve their organizational performance, for companies engaged in takeover or merger. M&A advisors also require such kind of a specialist to partner in and come on board with them. Because if you are an M&A advisor, as I said, you have to be holistic in terms of providing a solution to the client. It cannot be possible that you go to a client and pitch for business of merger or demerger only with the capability and knowledge of drafting. You need to have all other areas also into your domain so that you provide it as a composite package to the client. Then private equity funds and venture capitalists also look for such kind of due diligences. Now, these are two examples which we have listed out. One, we can say there are two companies, A and B. In company A, the decision-making habit is that a person in the meeting room with the highest rank or level make the final call. Second, can be a company which encourages the person closer to the customer to make the call. Now, these are two different business strategies and the decision-making. When these two companies merge together, you have to identify and streamline both the processes together. So if you implement the process of company A, probably the person who was more decision making in company B may feel neglected after the merger. This will create discomfort within the employees or vice versa. So you have to be sure and mindful in terms of how you integrate such kind of decision makings. The second option example is where company A gives flexibility to the employees for work from home and may continue with mediocre growth and increments. However, there is a company B which talks about work from office and they want the employee to meet on daily basis because this builds up more bonding and the strength between the team and opens up the floor for discussion. Now, a person who is habitual of working from home may or may not be equally willing to work from office for all 6 days. So again, you have to try and work out a balance or create a bridge so that the cultural differences can be merged upon implementation of the scheme. Then second is the IT due diligence. Today, what not, but every business requires IT in some or the other form. For example, if you are having a turnover of more than 5 crore, you have to generate your invoices electronically. If you are into the business of distribution, you need a SAP, or you are into warehousing, you need a SAP platform to understand where is your inventory lying, what are the positions. If you're into a business of manufacturing, you probably need to work on your supply chain, which again runs on an IT platform nowadays. So everything requires the information technology domain. Either your inbuilt home proprietary or software as a service is being adopted and then implemented into your company. Both kind of operation can work. So that is the reason why the IT due diligence is becoming a more and more relevant topic today. And professionals are moving into the business segment also. So what are the key steps required for IT due diligences? So you should understand the IT organization and processes of that company, whether the company has a SOP framed or not, what kind of SOPs are there, whether SOPs are followed by the employees routinely or not. So all these things have to be judged and verified. Then there can be IT strategies, projects and spending, that how IT is evolving and what are the current costs and investment in the IT. So a company may be moving from traditional business setup to a more advanced business setup wherein they want to integrate technology systems. So the costs which are being built up, that is also equally important to understand. Infrastructure and IT security. So whether you have an in-house server, you work on cloud. These clouds are whether the high-end data cloud providers like Amazon or Microsoft, or you are going with a third-party cloud service provider. What are the security levels? What are the access levels? Who all can have access to the data? The kind of data movements and how you can control the data movements, all those things come part of the infrastructure and IT security. You should understand this aspect also. Then there come the business systems and softwares. For example, a simple example. Today, a company buys a laptop. How do you use Microsoft Office? Or what is the Windows which you are using, whether it is a pirated version or you procure an original Microsoft license. Now again, this license is a normal license, which is a OEM license, or it is a paper license. So all those things have to be understood so that you can provide a holistic solution to the company. Now, what are the results of a IT due diligence? First, growth and scalability recommendation can be provided. For example, if you are going on an OEM license for Microsoft, you can always move to a paper license. That will save some cost in the long run, or depending on the number of employees you have. Then IT spend analysis and benchmarking. What is the spending you are making for that particular IT segment, and what is the market costings available? So it might be possible you are creating an in-house platform for SAP administration, which costs you 1 crore, but you can use a third-party software, which is available as software as a service, and it is available at an annual cost of 5 lakh rupees. So whether you want to invest 1 crore or you can work with just 5% of that value on monthly basis. This is a costing analysis which have to be undertaken. Then the costing analysis is also more dependent on the kind of technology. So if the technology is very robust and changing rapidly, so it's better always to outsource this rather than to spend in-house. So these decision makings again are dependent on the business and the industry in which these businesses are operating. Then risk identification, scope definition, and remediation priorities. And last is risk, cost, investment opportunities, and strategies. Opportunity strategies. These have to be given. So as a holistic, this report can be shared with the client to make the decision making more effective. These kind of IT due diligences, as of now, are predominantly taken under the technology industry, the startups, and all the disruptive businesses which are coming up. However, my personal opinion is that these will shift to the traditional manufacturing setups and the businesses also, because everyone requires a IT support system today. Then there are a few dates to remember when we do a scheme. Appointed date, effective date, record date. Appointed date is the date from which the assets or liabilities of the transferor company can transfer to the transferee company. Effective date is the date on which the scheme becomes effective and the last approval is received, so that the transferor company can dissolve. Record date is the date on which the shares are actually issued based on the members who are on that available on that date. So to give an example, if the scheme has been approved by the board of directors on 20th February, the valuation date can be 20th February. The appointed date may be 1st April 22 because it was in the month, it was approved in the financial year 22-23. However, the company always have a choice. They can also take the appointed date as 1st April 23 also. Then, however, one more thing you have to be mindful over here. When you take a appointed date which is older than 1 year, you have to give a justification to NCLT also that why the appointed date is older than 1 year. Then all approvals and the final order of NCLT are received, say, on October 31st. Then the scheme is filed on November 1st. So November 1st becomes the effective date. On effective date, the books of accounts are merged for both the companies, which will be April 1, 2023. In case of demerger, the books of accounts will be segregated. So any transaction which has been done after 1st April 22 till the effectiveness of the scheme, everything is believed to be undertaken in fiduciary capacity on behalf of the transferee company or the resulting company. Then after the scheme is effective, record date is finalized. On this record date, whosoever are the eligible shareholders, the allotment will be made to them. Then very rarely companies keep a mid-year at the appointed date because this requires an audit in the mid-year. Then there would be separate income tax filing for the mid-year period. So these things are generally avoided when you keep the appointed date at the end of the financial year or the beginning of the financial year. Then it does not alter the fair value. As we discussed, the appointed date can be 1st April 22 or a future date, say 1st April 23, but the date of valuation is February 28, 2023. So valuation date is more near to the board meeting date. Then operational challenges which are faced is that with effect from the effective date, the entire business will have to be carried in the name of transferee company. However, it might be possible you don't have the licenses in the name of transferee company. So all the things have to be prepared upfront. Wherever you need to engage agencies for shifting of licenses, be it Factories Act, operational business license, facile license, or any other, all those things have to be started upfront. Similarly, a scheme contains a provision which talks about the fiduciary relationship during the period when licenses are shifted. So you can always create such kind of provisions in the scheme also. Now another aspect is JV or the shareholders agreement, which is again critical as on date. So when we talk about a joint venture is basically a commercial arrangement between two or more independent entities who come up for certain economic benefits. Why? Because one of the party will lack the requisite asset or right to pursue the business independently. Second, this is a way of sharing cost or risk for entering into a new market or geographies. Then try before buy the whole. That is how you can take a decision in a wise manner without investing 100% of the equity from your side. Then access to commercial opportunities. You get benefited from the other party's strength also and realize synergies from strategic partners. Now, joint venture structure, this can be purely contractual, for example, cooperation agreement, or it can be in the form of a partnership or in form of a corporate joint venture. Most of the preferred route for the joint ventures are corporate entities or LLC. Now, under the JV documentation, what all is required? Predominantly, you would be requiring an NDA, exclusivity or non-exclusivity in terms of discussion, the term sheet, letter of intent, memorandum of undertakings. Then there would be a joint venture shareholders agreement. Then in most of the cases, the joint venture agreement terms also carried to the articles of association of the company so that it becomes more bounding and implementable under law in case of any dispute in future. When we talk about articles of association and the amendment, it can always be made in two manners. One, you can do a line-by-line amendment of each of the provision of the articles. Second, you create the present articles at Part A and you induct a new Part B into the articles of association. The new Part B will contain all the salient features in terms of the joint venture agreement with the rider that in case of conflict between Part A and Part B, the Part B will always prevail. So these kind of structures are also possible. Then deal with the ongoing relationships and other documentation in terms of asset or business transfer, IP licenses, debt documents, how the subscription will be made. So whether there will be a share subscription agreement or not, or whether it will be a transfer of share, and other commercial agreements have to be understood. So when we talk about shareholders agreement, these are the few terms which are very common and also important from the point of view of drafting of a JV agreement. The first is the parties to the suit. Who are the parties? Then come the definition. Few of the definitions which are important are affiliate, affirmative voting rights, charter document, claim, confidential, encumbrance, and key employees. So affiliate is required to understand that what are the affiliate parties and what kind of rights or liabilities such affiliates also have, or they can interfere into the business operation. Affirmative voting rights. It means that before making certain decision by the board, the party has a right to say yes or no. And if the party who is having this affirmative voting right says no, the company cannot go ahead with such decision making. Nowadays, this affirmative voting right is very prevalent into shareholders agreement in case of private equity fundings. So this is a way of indirectly controlling the board without coming on the board seat also. Then the charter document, we talked about the articles of association. There can be claim, confidentiality, and other aspects. Next is the effective date of this agreement and the conduct of shareholders or the company, how the business will be operated, what kind of rights or interferences the shareholder can do into the business operations, what board governing power the board has, whether there will be a board observer or not, board of directors, whether there will be a director nominated by the investor or there will be just an observer on the board. Then the affirmative voting rights will devolve on the nominated director or on the observer also. Then how such director can be removed or any other director can be removed from the company? What are the indemnities available in case any of the party breaches the terms of the agreement? So indemnity is very important clause under such kind of agreement because all these are high value transactions. Then affirmative voting rights, we already discussed. Then process of affirmative voting rights, how you can exercise these rights. That process is also documented. For the funding, so today you have already decided that the company, the JV has to be created with 100 crore funding. One of the partner will bring 60 crores, another will bring 40 crores. That's the understanding and arrangement. Once this is formed, how the future fund requirement will be met with. You have to plan for that from today in advance. So again, here comes the area where you have to be very mindful of the business projections and numbers and the requirement of funds in future. Then only you will be able to assess. Secondly, there are two JV partners. It might be possible one partner has deep pockets and they can fund in future, but there is a possibility that the other partner may not have such kind of funds available in future. So again, that is something which has to be considered before finalization of such further funding terms. Then what is the lock-in for each of the joint venture partner and how they can move out of the joint venture? Then the board meetings, who will be the chairperson, what would be the frequency of board meeting, how the notices will be issued, what is the quorum. So some of the pointers under this are, say for example, chairperson. It can always be said that chairperson do not have any casting vote. For the quorum, it can always be said that quorum will be 1/3. However, it is subject to availability of the investor director. So if the investor director is not available and the 1/3 is available, but still it will be deemed to be a deficit in the quorum. So you cannot proceed ahead with the meeting. So all such kind of things have to be drafted and incorporated in the agreement. Then the notices, how it will be given, the terms and termination of the agreement, in case the business goes for liquidation or insolvency. Then what are the representation of and warranty? So each of the party, they give their own representation and warranties about the factual statement covered under the agreement with respect to their obligations. These statements should always be truthful and should be this statement is something wherein if you default, then obviously the indemnity clause get invoked. So you have to be very careful while drafting such kind of representation and warranties. Then default notice, in case of default, how notice will be given, what are the call and put option rights available, and what are the other remedies available. Then affirmative voting right not followed, that can be one of the event of default. A misrepresentation of any representation of warranty can also be one of the event of default. These are few of the examples of affirmative voting rights. These are few which we have generally seen in all kind of agreements. One is change in shareholding, how it will happen, when it will happen. And second can be change in the charter document. Third is sale or disposal of any asset. Here the limit can also be specified, asset of value not more than 10 lakh or not more than 5 lakh. So these can be done in the ordinary course of business. If the value exceeds, then it needs affirmative consent. Then acquisition of any business, ESOP, whether to be given or not, that requires a consent because ESOP will always lead to dilution of the ownership. Then loan and guarantee, litigations or settlements, how it will happen, and the hiring and firing of the KMP, that is generally also covered under affirmative voting right. Now we also discussed about exit or termination, or in case of event of default, there can be a call option or put option. So as the name says, call is something you can call it at any time. Put is something you are eligible to ask the other party to buy what you are giving to him. So these are the two options available. These options are with respect to the securities which are being held. So the parties will have such kind of rights available in case of default. Another right which is available is the tag and drag right. So drag right is basically a right by which investor has a power to even pull the promoter shares. However, tag right is a right through which the investor can sell his shares also if the promoter is exiting the company in future. So how does it actually work? Say for example, there is a condition which is given that if the default happens, then the investor will immediately take an exit. But what happens? The promoter is holding 75%, the investor is holding 25%. No one will be interested in buying that 25%. That is the reason why the drag right is created, so that the investor, along with the 25, can pull the entire 75 also and make a sale of 100% of the business, because the competitor would be interested into 100% of the business. Similarly, the tag right says that if the promoter is making an exit, why should investor remain in the business? Because investor, when he comes into a business, it is also because of the promoter. So if the promoter is taking an exit, the investor should be equally eligible to take an exit. So that is the reason why these two rights are created in any kind of such agreements. So drag right is basically to eliminate any kind of third holdings along with the existing shareholder from the company. Tag is basically which offers a right to the minority to sell along with the majority. So these are the cases when generally a drag right is used by an investor. Any reps of warranty is given are proven to be wrong, or there is the occurrence of a material adverse event because of which the business valuations are deeply impacted. Then in case of any cost which may lead to credibility of the organization or continuation of its business operations, or on happening of an event of default. Thereafter, if the company or promoter fails to provide an exit to the investors at an agreed IRR, again the drag right can be invoked. Then if the company or promoter fails to provide an exit to the investor at all, again that can be one of the situation, and the promoter leaving the company. Whereas when we talk about tag rights, these are generally exercised uh, along with ROFR, which is right of first refusal. When existing shares or shareholder or identified shareholder or the promoter intend to sell, again there can be a tag right along with that. Then tag right can be proportionate of all. So for example, if promoter holds 75% in the same manner, promoter out of the 75% is just sharing or is just parting away 1/3 of his holding. So there can be two kind of clauses or the tag available to the investor. Either investor also can part with 1/3 of the holding. The second option which can be created in the agreement, that whatever be the percentage of the promoter exit, investor has a right to sell the entire 25%. So it all part of the commercial negotiation and how the agreement is closed. Now again, this is one of the anomaly which will definitely come across to you when you do the drafting of the agreements if a lawyer is not appointed separately. So there can be different definitions to a same term. This is one such definition of a term called cause. There is a one agreement which simply says that cause is commission of a felony or a crime of moral turpitude or any crime involving the company or any affiliate, or fraud, misappropriation, or embezzlement, and any other action as decided by the board. There is a second classic case wherein a lot of details have been given, including talking about the charge sheet or the set aside of the charge sheet or the day of the charge sheet and acceptance by the court of competent jurisdiction. So different kind of other aspects can also be covered. So it all depends the kind of client which you are dealing and the nature of business operation. Based on this, you have to get into the detailing of each and every clauses and the agreement which you are drafting. Then there is another document which is called a deed of adherence. This is generally in case of shareholders agreement or share subscription agreement, that if one investor is moving out and selling share to another, the another investor has to sign a deed of adherence. By signing the deed of adherence, the new investor gets replaced in the shoes of the earlier investor and is bounded by all the terms of the shareholders agreement. So this is one document which is very predominantly used by corporates while doing private equity investments also. Then there can be subsequent amendment of articles of association, we have already discussed. So you can always bifurcate your articles of association into two parts, part 1, part B, the normal articles and the SHA terms, and the SHA will always prevail whenever there is any conflict of provisions. However, yes, you can always provide a term into such article that as soon as the company gets listed, the part B, which is dealing with the terms of the shareholders agreement, will become inoperative. Because under a listed company, you cannot have such kind of terms and beneficial rights available to some of the shareholders. Now we'll come to the last concluding part, which is about the process and the intermediaries involved into the transaction structure. So first we talk about the intermediaries. One larger term which we talk is the transaction advisor. When we say transaction advisor, we refer to an entity which provides an end-to-end solution, which does not just draft the scheme or just give the valuation report or just represent the company before the NCLT. We are talking about start to end. That means from the date of initial discussion with the management that whether they should do such kind of restructuring, they should even discuss about doing such kind of restructuring. Then what are the businesses? Understand the business. What are the pitfalls? What are the plus and minus of each of the business segment? What should be done in terms of moving out of the business or taking in any new business? All those things have to be understood. So this is the part of the business process which we have discussed in this presentation. Then you have to understand the legal aspects, the approvals which are required by the company. For example, there is a sectoral regulator, there is a RBI approval required. So you have to assess whether such kind of RBI approval can be obtained or not. So you have to guide the company on such regulatory aspects also. When we talk about merger of a company, then you have to look for the due diligence also. And when we talk about demerger from one company to a second company, depending on which side of the transaction you have been appointed by the buyer or the seller, you have to undertake the due diligence also. Thereafter, you have to work on the taxation structures. What are the tax impacts? Then there may be independent valuer, there may be independent merchant banker. You have to go through their reports also to understand the entire formulation and the structure and whether it is falling in the right direction or not. As we discussed, there are various points related to valuation. You can always look onto such kind of pointers, understand the valuation, so that when you deal with the regulatory authorities in future, you are clear about the valuation aspects also. Yet there is a conflict of interest. If you are doing the transaction advisory, you cannot do the valuation and you cannot undertake the merchant banking activity. But otherwise, you can entertain the client for the entire structure. After this, representing the client before NCLT, and thereafter post NCLT approval, implementing the structure and getting the stock exchanges and SEBI approval. So these all are the roles of the transaction advisor. When we say transaction advisor, yes, there are intermediaries available in the market who do everything. So they do everything based on two manners. One, they have the capabilities in-house. They have all kind of professional on roles, and these professionals provide respective services. Second can be you select the right business partners. You select the right chartered accountant, you select the right indirect tax advisor, you select a lawyer, you select a valuer, a merchant banker. You put all the pieces together and provide a composite solution to the client so that the client can rely on your expertise and your team's expertise and strength, and you can execute this transaction. Then comes the valuation. Mostly one or two valuers are appointed for the purpose of undertaking valuation in the share swap transaction. However, there can be certain intricacies involved into it. Certain times there can be applicability of FEMA. Under applicability of FEMA, you can always look for two kind of valuers. One is registered valuer, another is merchant banker. Because FEMA law as of date do not recognize registered valuer as a valuation specialist. You can take a joint report also. You can take segregated report from both the intermediaries. It is up to the choice of the transaction advisor how you want to move ahead with the transaction. Then there will be a requirement of a merchant banker. So the merchant banker will issue a fairness opinion on the share swap ratio and for taking due diligence certification for the unlisted company, and the disclosure will be made in the format of average prospectus. But you have to see that this requirement is only when you are dealing with a listed company. If no listed company is involved in the transaction, you don't have to go to the merchant banker. This intermediary is not required. Then comes the PCS or lawyer. Nowadays, most of the work are being done by PCS only. Lawyers do not come into picture for though as a professional they also undertake such businesses. But being a PCS, you are able to handle the entire transaction structure in-house. You can always do that. So the appearance before the NCLT, then handling matters and the interaction with ROC, RD, OL, responding to their queries, getting the NOCs from them, all those things can be handled at your end also. Then there can be a different set of intermediaries to interact with the stock exchange, taxation authorities, CCI, other regulators like RBI or IRDAI or any other regulator for seeking their respective NOCs. So each of the regulators said that if you are undertaking a transaction, before executing and implementing the transaction, you need to have their NOCs or approvals. Now, what is the role of the transaction advisor? The first and foremost is that you have to give the architect of the entire structure. Whenever you get a building constructed, the first thing is you create a building plan and get the approval. The same is the role of the transaction advisor over here. You create the entire structure. You should know that what is getting merged, what is getting demerged, what are the businesses which will consolidate, what are the businesses which will get hived off, what are the processes which can be combined in terms of business operation, which asset should go or should not go. Even you can go ahead and play a role into it, that when you are doing a demerger, whether a particular asset should form part of the demerged entity or business or not, you should be able to advise onto it. Thereafter, under the transaction structure, you also have to give a taxation statement. What are the implications of direct and indirect tax? Direct tax, we have discussed, it will be predominantly the income tax in terms of whether you can avail exemption under Section 47 or not. And secondly, whether you will be able to carry forward the losses or not. These are the predominantly two aspects related to income tax. When it comes to indirect tax, nowadays it is mainly the GST, because all other different kind of indirect taxes have been merged and combined into GST. Then there would be an applicability of a stamp duty, which again needs to be verified. Again, I'm saying stamp duty is very critical because most of the transactions, if they involve immovable property, there will be multiple taxation aspects onto it. Even if I'm not wrong, Rajasthan state has also even laid a stamp duty on conversion of a LLP into a company. So stamp duty is something which you have to be verify very clearly and tell the client what kind of costings are coming onto it. Thereafter, what kind of approvals you require? Companies like SEBI, FEMA, RBI, IRDAI, or any other regulator. Certain times the company may be conducting business under atomic energy. So you again need to see whether you need a approval of AREB or not, or Atomic Research Board or not. So all such kind of requirements will come. Competition Act is another law wherein you have to see if the provisions are getting triggered as per the circular of the Competition Commission of India. Then you need to apply for CCI approval also. Then in the next step, you have to get work on the ground. So you have to start building up the documents, the draft of the scheme, the supporting documents which are required either for stock exchange approvals in case of listed company, or the documents which have to be filed with NCLT directly for the unlisted companies. Now, if you are acting as a transaction advisor, you should have this strength in-house. If you are not acting as a complete transaction advisor, you can outsource few of the activities and rope in your business partners. It is very necessary to identify a right business partner because most of the aspects over here involve monetary compensations. So one wrong decision can fall, the entire transaction can fall in future. So if you are not able to assess the stamp duty, it may be possible even after receipt of NCLT order, but before filing with ROC, you have to pull out the transaction because the stamp duty impact would be too high. So this had to be monitored very carefully. And at the end of the day, as an advisor to the client, you always have to face the client for the decision taken. Then thereafter, it will be obtaining and follow-up of the NOCs from the regulatory authorities in terms of RD, ROC, OL, and income tax. Then assessing and finalization of documents for listed companies, either prior or post implementation of the scheme. Post implementation, there can also be a situation where the company is required to obtain a 19(7) relaxation for listing of an unlisted company. Under such a transaction, you have to take care that the listing approvals are received within 60 days from the date of receipt of NCLT order. That is the outer time limit provided under the SEBI regulations. And post-scheme compliances and concluding the transaction is also required because as a transaction advisor, you have to work on the entire thing. I would again repeat the same thing that if you have in-house team, your in-house team has to do that and it is your responsibility. Else, if there is a partner associated with you, the partner has to come in and close these compliances. It can be merger of books of account, the accounting support, adjudication of the stamp duty, then obtaining fresh license or the transfer of the licenses of the company, all these aspects. Now, this is an ideal process of a scheme of arrangement. Again, depending on the transaction and the structure, the process may change. So first of all, the board of directors of the transfer and transferee company have to consider and approve the proposal, initial proposal. Then the scheme has to be finalized. In case of listed company, the independent director committee and the audit committee have to approve the scheme or recommend the scheme to the board. Thereafter, the board of directors will give their approval. Then the draft scheme will be filed with the stock exchanges. On the first level, the exchanges will review the scheme and then forward the scheme to SEBI with their comments. Then SEBI may also come up with certain questions and thereafter SEBI will give their NOC. Post receipt of NOC, the scheme can be filed with NCLT. Till that stage, the time required is around 2 to 4 months. Depending on the structure simplicity or the complexity, the time can vary. So once you file the first motion petition, you have to convene the court convene meeting for the equity shareholders, unsecured and the secured creditor. After this meeting, the normal report, the chairman report and other documents have to be filed with ROC. Thereafter, the second motion petition will be filed. Post which the NCLT will issue direction to RD, ROC, OL and income tax for their observations or confirmations. Once you get all these approvals or NOCs, then the NCLT will pronounce the order. From the receipt of NOC of stock exchanges SEBI till the receipt of NCLT order, the approximately time frame required is 6 months. Thereafter, the final listing application will be filed with the stock exchange for listing and trading approval. Allotment will be done. As I said, in 19(7) relaxation, it has a time period of 60 days, which has been specified. Thereafter, the corporate action will be done and the share trading will start. You complete the transaction. This entire process takes around 10 to 15 months for completion. So this was all about the presentation. Synergies is something which you have to create with your business partners and you have to identify the business partners. As we discussed, the business partners are predominantly your chartered accountants, the lawyers, and the fraternity who works with the stock exchanges. So these agencies have to be identified. You can build up a long-term relationship with these agencies and take your business to the next level. Thank you, Richard. Thank you, everyone.
Thank you so much, sir, for giving such a detailed presentation. So we have received few questions from our participants. So if you permit, like we can take one by one.
Absolutely.
So the first question is, should the valuation done previously form the basis for next round of corporate restructuring, or can it be less or more valued next time?
So value is something which is always calculated for a particular point in time. a value can be more or less for any company even with a span of 2 months. If the value is falling drastically or increasing drastically, you always have to justify that why such movements have happened. If the numbers of the company are able to justify, then the valuation will definitely increase. For example, I know a company which for sure was selling 3 lakh rupees worth of goods on monthly basis. That's a B2C brand. And in next 2 years, they moved from 3 lakh to 3 crore a year. So this build-up has happened over 24-month period. But this is a very aggressive build-up. So in such kind of businesses, the valuation can change every 2 months also. However, you have to justify that valuation. So, for example, if you do a valuation, I cannot change the company specific risk every time. I cannot do 5% once for first valuation, 4 for another, and 6 for another. So my assumption for that company should remain static. Based on the projection number, the number can always change.
So our next question is post-amalgamation. The effective date of scheme is 1st April 2021 and financials of the transfer company was restated from 1st April 2021 and the consideration that is the allotment of shares to the transfer company was made on July 2023. What would be the accounting entry for share capital in this case?
No, so the books of the company will be merged with effect from 1st April 2021 only.
Okay,
The
sir.
allotment of shares is a different act. The shareholders accounting and taxation is different. The company accounting is different. So from 1st April 2021, the books of accounts will be merged or demerged based on the transaction which is there. The capital, for example, I'll give you an example of demerger. In the same case, if the appointed date is 1st April 21 and the allotment is happening in May 23, you have to recap the balance sheet of 1st April 21. Now in 1st April 21, the resulting company may not have capital or will have a capital of nominal capital of 1 lakh. But the allotment which is happening is 1 crore. So what happens on that 1st April 21, the balance sheet either shows a capital suspense account of 99 lakh and then the balance sheet is created with a proper disclosure note that the capital suspense account is coming out of the demerger exercise. So the balance sheets have to be merged or demerged with effect from appointed date only. When we talk about the allotment and transfer, so a shareholder earlier may be having a share worth 100 rupees for the company. Now that company has splitted and demerged the business operation, they gave a ratio of 1:1. Now what happened? The person was holding one share of company A before demerger. Now he holds share of company A and B post demerger. This company A, one share was bought at 100 rupees. Now how you bifurcate this value of 100 between company A and B after demerger? So again, there is a provision under Income Tax Act under Section 47, which says that the percentage attributable to the cost of company A and B cost would be based on the percentage of net worth demerged. So your ratio can be 1:1, but the net worth getting demerged may be 70:30. So your cost of acquisition of 100 rupees will get split into 70:30. So this is the treatment with respect to the shareholder books of accounts.
Okay, sir. So it depends like how it is happening.
Yes, but the books of accounts of the company will always be merged or demerged with effect from the appointed date only. As I said, for the share capital, you have to show the share capital suspense account only.
Right, sir. So we have a next question, and that is like, what is the legal fees to apply for such kind of transactions?
There is no legal fees into NCLT. The kind of costs which are there are one, the transaction advisor costs. Again, it is a service which you are providing, so there is no benchmarking for the cost. But ultimately, the cost should be reasonable to compensate your efforts and should be reasonable so that the company is also able to pay you. So you have to find the right balance into it. Second, apart from the transaction advisor cost, there would be valuation related costs. There would be the merchant banker related cost if listed company. Then if listed company, there are costings related to SEBI and stock exchange applications, which are generally for stock exchanges, it are based on the number of companies which are involved into the transaction. For SEBI, it is a percentage-based fee subject to a maximum of 5 lakh. NCLT, there are certain nominal fees which you have to pay in the process. Then there are costings related to shareholders and secured creditor meetings. certain advertisement costs, and then finally you conclude the transaction, there would be some out of pocket, and lastly the stamp duty. So these are the broad bifurcations in terms of costs which are involved into the transaction. There is no legal cost as such.
Okay, sir. So we have a next question, and that is, are cross-border transactions subject to certain special legal requirements?
You just have to follow the FEMA requirements also. You have to ensure that it is in compliance with FEMA norms. Apart from that, there is no other specific requirement. When we talk about a merger or demerger exercise, so Companies Act 2013 has allowed such exercise. However, you also need to verify the laws of the parent country where the other company is situated. For example, the counterpart is situated in US or Europe or Mauritius. You have to check for the laws of those land also.
Right, sir. So our next question is, what is the role of board in this whole process?
The board has the supreme role in this. So ultimately, if anything goes right or wrong with the merger or demerger process, it is the board who will get the credit or will be held liable for this. Especially if I talk, because most of the closely held companies do not get such kind of intricacies. We'll talk more from the listed company perspective. So if there is a listed company, it may have 5, 10, 50,000 of shareholders, public shareholders. So the board has to simultaneously see that none of the interests of the public shareholders are affected in general. In specific, no one can go ahead and check, but in general, none of the interests of the shareholders should get affected. If it happens so, or if any of the provision of the scheme is believed by the regulator that it is prejudicial to the interests of the shareholders, the board, the audit committee, and the independent directors committee will be liable for that.
Right, sir. So our next question is, why a deed of adherence and not a novation agreement?
There can be different ways of doing the same thing, but deed of adherence is something which is predominantly used nowadays. Novation is something basically which you are transferring one entity to another entity. So novation is signed in such cases. But deed of adherence is that the legal entity continues and the shareholder changes. That is the way deed of adherence is required.
Right, sir. So we have few more questions. And this is, does the promoter shares can claim any additional value that can be substantiated under income tax?
Can you repeat the question?
It is, does the promoter shares can claim any additional value that can be substantiated under income tax?
Maybe I'm not able to get the question clearly, but there cannot be a difference between the valuation of promoters and public shareholders. All the shareholders will be at par only. So the ratio will remain same for every category of the shareholder. So there is no preferential treatment for anyone.
Right, so it pertains to some like income tax treatment they are asking. There is no difference.
No, there is no difference. Even under income tax also, if you are not giving a preferential treatment to anyone, then taxation law stands same for each of the shareholder. So if your transaction is tax neutral, the transaction will be exempt for public shareholder also and promoter shareholder also. If the transaction attract taxability, it will attract taxability for both of the category of shareholders. So there is no difference as such.
Our last question, which valuation would we take into consideration if there are two valuers, and how to ascertain this?
This is a tricky question. Generally, that is the reason why I have also emphasized, and we always recommend that there should be a joint report by two different valuers. The working they can incorporate separately, but a joint report is something which gives you a uniformity in the valuation. If there are two different valuations, there will always be a question that which valuation to use, because if one of the company shareholder is getting benefited, another company shareholder will stand at loss. When we talk about listed companies, so obviously you have to adopt that valuation which is more favorable for the public category shareholders. But for an unlisted company, it is indifferent. You can adopt any of the valuation report.
Right, sir. Thank you, sir. Thank you for answering all the questions. And now it is, thank you, sir. Now it is the time to conclude this webinar session of Master Knowledge Series. We extend our heartfelt gratitude to all the participants for making this webinar more interactive by sharing their relevant questions during the webinar, and our guest speaker for attending and addressing all such queries. On behalf of the ICSI, I extend my sincere thanks to our speaker, CS Nitin Somani, and my professional colleagues for sparing their valuable time and participating in the webinar. Thank you, sir. Thank you.
Thank you to all the members, and thank you, Institute. Thank you.